Yeah, so we'll go ahead and get started. I'm Owen Bondurant. I'm a partner in Independent RX. Just a couple housekeeping things. We do have a Q&A that you can ask questions in. We won't be doing live questions, but if you put the question in the Q&A, we will be following those and we'll answer them either as we're going through or at the end. We'll do our best to answer as many of them as possible. And welcome again to Pharmacy Accounting, called it Pharmacy Accounting 202. We're just going to try to dig into more of the detail of pharmacy accounting, kind of why it's difficult, some of the problems that we see with it, some of the strategies, and then also how it might affect how the bank looks at all of this, because just about everyone on here is either getting a loan, has a loan, or selling to someone who will need a loan. So your pharmacy financials and tax returns are a key aspect to the bank. So luckily we have Bobby and Bo who can talk us through that. And then we also have from First Financial Bank, and we also have Rich and Jim from Independent RX, who are both CPAs. I will pass it over to them to let them introduce themselves. Rich, why don't you go ahead and introduce yourself?
Yeah. My name is Rich Stenhoff. I'm a partner here at Independent RX. Give you a little of my background. I'm a CPA, like Owen said. Started back way in the day with PricewaterhouseCoopers and public accounting, and not at all involved in pharmacy for half my career, and then for the second half, the last 16 or so years, 15, 16 years, been involved in pharmacy ownership. We owned at the peak, I think, about 17 stores across 3 states, and kind of led into the business that we have now. So we still have some stores, a couple of stores, but the primary focus now has been helping others operate and own pharmacies, right? So at IRX, we cover the full life cycle of pharmacy ownership, whether it's buy or start a pharmacy, it's operate a pharmacy, or it's sell a pharmacy at the end of the road. So we do all those things. Today, we're kind of going to dive into the middle section of that, the ongoing and operating a pharmacy, where we're going to talk about some of the accounting, and we do that for a number of pharmacies. Accounting is kind of a means to an end. The end is to operate your pharmacy better, right? And so we need good information. We need to understand the accounting, the taxes, and the things that drive that, and so that you can make better decisions and operate your pharmacy better. That's the goal.
I'm Jim Sunderland. I'm the director here of finance and tax. Like Rich, I started off in public accounting at PricewaterhouseCoopers back in the day. I was there for about 9.5 years. I went into private industry after that. Before I came here, about 20 years, the 20-year period before that, I was CFO at 3 different companies, and I've been here for about almost 3 years now. So,
Oh.
Yeah. First of all, thanks for having us. Looking forward to today. My name is Bo Garman. I'm a loan officer with First Financial Bank. Been in banking, a long time, but about 10 years ago, First Financial Bank decided we were going to develop a division dedicated to working exclusively with independent pharmacies. And so I've been lucky enough to be on board with them and helping independent pharmacies find financing solutions, whether that be for an acquisition or an existing owner who needs capital. So again, looking forward to it. We'll have some fun today when we're Rich talking about accounting.
Of course. Yep.
Bobby.
Yeah, thank you for having us on today, Owen. My name is Bobby Glaze. So I'm new to the bank. I've been here for about 2 months with First Financial. My background is I'm not a banker. I'm a pharmacist. I've been a pharmacist for the past 10 years, the last 9 of which I managed an independent pharmacy in South Arkansas. We had 2 stores, did a little over 200,000 prescriptions a year. And so independent pharmacy is near and dear to my heart, and seeing the continuance of it. I come from a family of pharmacists. My granddad owned his own stores. My uncle has multiple stores. And so I'm committed to continuing independent pharmacy throughout this country. And so excited to be a part of the First Financial team and try to help other people, chase that dream of independent ownership.
Yeah, thanks. Yeah, thanks, Bobby, for joining us. As you can tell, we have quite a bit of experience and a variety of experience here. So hopefully we can provide some value. One of the big questions that we hear all the time is, should I do cash accounting or should I do accrual accounting? I thought maybe Rich, Jim, one of you could maybe, or both of you could go through kind of first off, what's the difference between the two? Because we need that to figure out what you should be doing. And then maybe we can kind of get into some of the details of that.
Yeah, we get that question a lot. We see both. We've done both. We get current clients that go to seminars and they tell you if you're not doing accrual accounting, you don't understand your business. And so that was kind of why we picked this topic. I think it comes up more frequently than any other question. And so we thought we'd talk through that a little bit. First of all, for those that, I think it makes sense to start out with an explanation of what the heck accrual accounting is versus cash accounting. And maybe the easiest way to start that is to say, okay, an example would be, so cash is all about cash. It's when you record transactions when those transactions hit your bank account. So when cash comes in or when cash goes out, that's when the transactions are recorded. And in accrual accounting, it's not so worried about when the cash is moving, but it's primarily focused on a principle called matching. And it's trying to match revenues and expenses used to generate those revenues in the same period. And so with accrual accounting, there's a lot of value in accrual accounting. We've done accrual accounting at Fortune 100 companies. We've done S1 registrations with, SEC reporting. All of it requires accrual accounting for their investors. And so GAAP-based accounting. The good news is that in pharmacy and in independent pharmacy, and when you look at the banks, for the most part, unless you've got a large commercial loan, you're probably not subject to GAAP accounting, which is going to require accruals. So now we've got choices. And so, as we look at, how we accounted for our 17 stores and did the accounting, there are challenges with accrual accounting in pharmacy, and we'll kind of talk through a little bit. But a good example is, so you're filling a prescription. And let's first look at accrual accounting. Accrual accounting would say, when you push that bottle of pills across the counter, so a script of 30 pills, that is a point in which you recognize the revenue that 30 count is going to generate. And you're going to recognize the expense of just those 30 pills. And that's the matching principle right there at the point of registry, at the registry. And they're going to walk out the store with that script. That's when the revenue and the cost associated with that script are going to be recognized.
Because that's deemed to be when the revenue is recognized or, earned basically, and when the cost is incurred.
Mm-hmm. So then when you flip the script and go to cash is going to say, well, when did the money leave the bank? So the money leaves the bank when you pay your wholesaler or you buy it off a secondary and you pay your secondary. And it's not just for the 30 pills in that script. It could be 1,000 count bottle, right? So I buy 1,000 count bottle, and when I pay for it, I'm going to recognize the cost at that point. And then I'm eventually going to dispense it. And then I'm eventually going to get paid. I might get paid at the register for a copay, or if it's a cash script, and that's when I would recognize it at that point. Or when my third party 2 weeks later, 3 weeks later, finally sends me a check, I'm going to recognize the revenue at that point. And so it creates a timing difference, as opposed to the matching principle where everything happens at the point of sale. With cash, you're creating a timing difference. You're purchasing up front, you're eventually dispensing, and then you're getting paid. And so there's a difference. There's not that same matching occurring at the point of sale. And so they are definitely two different types of accounting. And so what are the advantages and disadvantages? Well, when we look at cash accounting, the problem is that pharmacy systems aren't necessarily built to generate accounting information. They're they're taking care of the patient, they're tracking the script, it's all about, patient care. And some pharmacy systems are better at it than other, but tracking that cost within the system. And the challenge of getting your inventory right. How many pharmacies have precise inventories? None of them are exact. You've got so many factors with rebates, with returns, with substitutions, all the different things that happen to your inventory within your pharmacy system. Receiving an order from a secondary versus a primary, how does your pharmacy system handle that? So there are all these factors that are going on, and this is what we experienced across our stores. You've got employees checking in orders, different technicians every day checking in orders potentially. Things get screwed up very quickly and go south very quickly. And if our financials are solely relying upon the pharmacy system to be accurate, if we don't keep the pharmacy system and the inventory and the receivables, so reconciliation on the receivable side and on the sales side, if those things aren't precisely accurate, then our financials aren't accurate. And that's what we experienced in our own stores. That's what we see across the industry, is that rarely is the inventory and therefore the cost of goods, the reconciliation, the receipt, and therefore the AR and the sales precisely monitored and controlled and correct. And therefore the accrual accounting on the pharmacy side is really difficult. So that's why, we look at this alternative cash basis of accounting.
And Bobby, Bo, I mean, how often do you guys see like accrual financials, for example, where the inventory has just been fixed for 3 years? And, it just says, hey, inventory is 150 and it hasn't changed in 3 years.
Yeah.
Even
No,
though,
very common.
yeah. And that's a problem, right? Because then we start not trusting what the margins are, because, the financials are really, accrual financials are really dependent on the accuracy of the balance sheet. So if your inventory isn't moving on the balance sheet, then the P&L is wrong. And that causes a whole nother issue for a lot of pharmacy owners, is that, they don't understand and I shouldn't just say pharmacy owners, I should say people in general don't understand how the balance sheet and the P&L relate to each other, especially in accrual accounting.
Yeah. So back in the audit days, right, you always start with the balance sheet. So those are things that are verifiable: cash, receivables, inventory, payables, debt, fixed assets. Those things are all verifiable. You can look at them and come to a conclusion as to what's your cash balance today. So you always start with the balance sheet, which is the exact opposite of what 95% of the people do. They start with the P&L and often don't look at the balance sheet. But the problem you alluded to, we see fixed inventories, so they never change the inventory. And if that's the case, then the cost of goods sold is basically cash, because you're running the purchases. Or we see a fixed margin on the P&L. Oh, I think it's 18.5%. Therefore, every month I'm going to book 18.5% margin. I adjust my inventory accordingly. And so when we start doing those things, we can guarantee that our financial statements aren't accurate from an accrual standpoint, right? So that's the impetus where we look at cash. So let's talk a little bit more about the advantages of cash. The one thing that is absolutely true is that what your balance in your bank statement is, if you have cash in the bank statement and it's reconciled every month, which we should all be doing, that cash basis financial statements are accurate, right? Whereas the pharmacy system and the accrual, we don't know, because we're not verifying and we don't, those inventories are off, then the
so many factors involved.
Yeah, on the cash side, cash doesn't lie. It's absolutely true. What happened in the bank statement happened in the bank statement. If that's your source, you're no longer relying on the pharmacy system now to generate your entries and to do your financial statements. Your financial statements are based on what's happening in the bank. So now we've got two different sources of information, right? And so on the on the cash basis, we're using the bank accounts and the credit cards and so forth to generate your financial statements. And they're telling you exactly what's happening from a cash standpoint in your business, which is also the most important thing that you should be paying attention to in your business, right? But we got to be careful not to lose sight of some of the things that accrual accounting is trying to monitor. Receivables, inventory, those are your two biggest assets. So we don't want to lose sight of that. And all those items are still available to you, right? You can still look in your reconciliation, and if it's accurate, you can see what your receivable is. You can still look at your inventory from your pharmacy system every month and see what your inventory is doing. Is it going up? Is it going down? And work to keep that accurate. But now we're no longer dependent upon that being accurate to have accurate financials. And so that pharmacy system is doing that matching for you. You can run a prescription summary report every month, and it will tell you I filled 5,000 scripts. Here's the revenue associated with those 5,000 scripts, and here's the cost associated with those 5,000. So you've got the accrual picture already in place, just looking at your regular reports off your pharmacy system. And now we've got the cash basis financial statements that are running independent of the pharmacy system that are telling us another story. And hopefully when we look at the two, they make sense in combination, right? And so if there's a major disconnect between, let's say, the margins between the two, then why would that be, right? So one common example would be if you're growing and you're picking up a ton of scripts, you're buying a lot of drugs and paying for those drugs well before you're getting reimbursed. So you could expect in a high growth that you're building inventory and that your margins in a cash basis would be lower than they would be on an accrual basis. So your pharmacy system may say, I'm doing a 19% margin. You might show a 13 or 14% on the cash basis. But that is truly a cash basis margin because you're buying a bunch of drugs and eventually, down a month or two, sometimes down the road, getting the revenue associated with those purchases. So there are reasons when you look at these two, and that's where you've got to understand what you're looking at and understand how to reconcile, but looking at the complete picture. And so, that's why we would say, for, another topic that we're going to talk about in a little bit is simplicity and having those financials available and understanding what they mean and having access to them, that cash basis has a whole lot of value to you as an owner to be looking at cash basis financial system, but not disregarding the fact that, your pharmacy system is also telling you, doing that matching for you and telling you basically the accrual side of your. Yeah. So, and even with tax and Jim's, specialty is the tax side. I think you see the same.
Yeah. There's a lot of times when we're looking at, clients or new companies coming on, we're taking a look at the tax return. And then also we want to make sure that we can reconcile that to the financial statements. You'll see many times where that does not work. It should work. And there's a process in the tax return called the M1 reconciliation that takes you through from the book income to the tax income. It should be an easy way to reconcile what's reported on the books and what's on the tax return. Like I said, it doesn't always work that way. And if it does, it gives you a better feel for, hey, are the financials in pretty good shape, because you can reconcile it to the tax return. Now, why would there be differences in the tax return compared to cash basis financial statements, assuming your cash basis on tax return? There's still going to be items that are income for book purposes that might not be taxable for federal purposes. Likewise, more common, there's going to be expenses that are not deductible for tax purposes, even though they're deducted on the cash basis financial statements. Also, a lot of times people will mirror depreciation methods between the books and the tax return because they want it to mirror together, but it's not always that way. So sometimes there's differences relating to depreciation as well. But the M1 reconciliation is a very important thing to do or to look at when you're really trying to see, okay, are these tax returns in good shape, and how's the financial statements as well?
Yeah, and I think you make a good point there. Sometimes you can have accrual-based financial statements and you could still file tax returns on a cash basis, right?
Right. And there's an advantage to that too. Well, to be cash basis for tax purposes, you have to have average annual revenues for the 3 prior years, 27 million or less. And that was based on the 2022 numbers. It increases a little bit each year, but if we just use 27 million. So if you're under that, you qualify to use cash basis. And the one advantage with cash, just at the very beginning, is you're going to defer income taxes, not permanently, but for a long-term period, because what happens is if you're going cash basis versus accrual, then under the cash basis, you're recognizing less revenue up front because things that you're going to collect later that you would put on the books or on the tax return on an accrual basis, you don't have to put that revenue on the cash basis. Likewise, there's some expenses that you wouldn't recognize as well, but overall in a profitable business, you're going to have excess revenues you're not recognizing over any costs you're not recognizing. So that is a deferral that's going to last as long as you own the pharmacy and you keep staying on the cash basis. You're basically taking that income and not paying the tax on that until the very end. So it's kind of a long-term deferral. It's not a permanent because it's
a timing difference.
Yes, it's timing difference. Very little things are permanent differences per se. So.
Yeah, a good example of that. I mean, basically what you're saying is you're going to accelerate deductions, which is a good thing because you're going to take it as soon as you pay it. And you're gonna extend out and you're gonna defer the recognition of revenue until you actually get paid. So if you're billing scripts in the second half of December and you're not getting paid until January, you're not going to pay taxes on those scripts under the cash basis until the following year because you didn't receive the cash. So that's the timing difference that Jim's alluding to.
And once you do that, then as long as you stay consistent with that throughout the year, if you got the first year you're on cash basis and you continue with that every year, you're going to have that same type of situation happening where the revenue in January will be recognized in January, but the next year's revenue that related to scripts you filled in December won't be recognized until the following January. So it's always kind of a lag from that standpoint once you started on that, which is a big advantage for tax purposes.
Yeah, so that's really good. Bobby, how does the bank look at all of this?
And that's a good question. And we see it both ways. And for the reason, Rich, you just discussed, that's why banks are often going to ask for 3 years worth of tax returns. There's a number of reasons, but especially on a cash basis, that you see that rolling methodology. And as you said, you can't defer it forever, but it rolls from one year to the next. Instead, obviously, if the first year, if you were to change from cash to accrual, it would affect it. That being said, at the end of the day, when banks are analyzing financials or making credit decisions, we've got to rely on the tax return. So if the P&L is different than the tax return, it kind of raises some red flags. But at the end of the day, the tax return is going to trump that P&L. So, if you're looking to possibly sell and maybe switch from accrual to cash right now, that would affect the value if you're recognizing less income right now, right? Therefore, you're not paying as many taxes, but your profitability is not where it should be based on that tax return. So those are some things to consider when you're choosing which method. I'm not a CPA. I'm not here to tell you which way is better. I would one, have you ask your advisors, and they can advise you. And two, make sure your advisors understand the pharmacy business. I think that's important.
So along those lines, you mentioned something in there, Bo, about just, as a seller getting ready to sell, and when you guys are looking at tax returns, Rich mentioned simplicity and materiality in this whole thing. What are things that you see in the tax returns that cause problems, I guess, or in the P&Ls, I guess, for that matter? Yeah.
Well, and getting off subject a little bit, but mainly is, we often look at sellers that have, personal expenses, or what we refer to as an add back to what that pharmacy is generating. And a lot of times the sellers they'll have a long list of things that they claim that they're paying for out of the pharmacy. But when you go to the P&L or to the tax return, you can't locate those. There's not a, expense line item for that particular item. For instance, country club dues or something like that, but there's no dues and membership expense line or something like that. The other is, when looking at the cost of goods on the tax returns, sometimes there'll be a large movement in the beginning inventory to the ending inventory. And that can really change what that gross profit margin is.
Yeah, I think that causes multiple problems, not only from a bank looking at it, but also, you as an owner, if your books aren't done the same year to year, and you're moving country club in and out and moving it from dues to, personal to salary to moving it to, we see this a lot with auto, people will put their car on there and 1 year it's under delivery and 1 year it's under auto and 1 year it's under insurance. And you're like, I don't know where this is. And so, when you're managing your business and if you're having these expenses change all the time, you can't tell from year to year, did this expense really increase? Did it decrease? And so we see one of two things. We see people just kind of move things around and kind of dump it in normal, like into certain categories, or they line item every single little tiny thing. And so then we have this general ledger that's, 700 pages and you can't find or figure out what is happening. So I think it is important to keep things simple, but have enough detail for you to make good decisions. And if you can make good decisions, the bank can probably make good decisions. Would be kind of what we see.
Yeah, consistency in how you record things, having obviously enough detail in your P&Ls and balance sheets to understand what you're looking at without, tracking every little expense and nuance. It's really important. We do a lot of valuation work as well. So not only do we produce our own, financial statements for our clients and for ourselves, but we also do a lot of valuation. We look at a lot of different pharmacies from a start buy standpoint. We've purchased, probably 30 plus of our own pharmacies over time and then sold. So all that is, your financials and your tax returns are really important, and making sure that you're handling things right and understand, and there's a methodology. We can pull those expenses out if we can find them, right? But finding them and making sure that we understand what's underneath is really important. And we talk about DIR fees and rebates, and that's another question we get a lot is, my local accountant, doesn't know what to do with the DIR fees, doesn't understand them. From our side, there's an argument from a GAAP accounting standpoint that those should be potentially expensed, and down in the expense section below, again, we're not subject to GAAP. So, for us, we show them as what's called a contra revenue. So when you're looking at your revenue section, that is a clawback of revenue that was paid to you, especially, for about half of them. Some of them are getting to the register now with some of the Humanas and Aetnas and stuff, but still the care mark can be, 150 days out by the time that DIR shows up. And we've seen DIRs creep up from, I think on a client average, we used to be about 3.3% of brands. Now we're seeing that get close to 8, 9, 10% of brands. So those DIRs have gotten very significant. We do break out, you should be breaking out DIRs as a negative revenue, right? Reducing the revenue that you're generating, and so that you can get to a more accurate overall gross margin by having those DIRs in a line item. And the only way to have them in a line item is to be using reconciliation, right? If you don't have reconciliation service and you're trying to figure out what your DIRs, you're gonna have to look at every single EOB and track those down.
And really, it's good representation of, you can really help manage the business more by saying, here's our DIRs of our total revenue.
Yeah.
By having them right visible on the P&L.
And the same goes with rebates. I mean, rebates are in that same vein. And, you have rebates that may be paid a month in arrears, and maybe paid a quarterly, maybe paid annually, where you get a large lump sum rebate every year. And so those rebates are a contra cost of goods, right? So they are an add back to cost, so that they are reducing your cost and they're impacting your margins. And so it's important to be able to break those rebates out and make sure that you're looking at from month to month to month, are my DIRs changing? They will, because in some cases you do have certain months that are clawback months for certain types of plans, but they're also getting fairly consistent because a lot of them are currently at the register. So you're looking at DIRs month to month to month. You're looking at those rebates month to month to month. I can tell you, our experience with rebates is they are often not correct. And so making sure that you're looking to make sure you're getting those rebates. I mean, every percentage point of gross margin is critical in today's environment. And so looking at those rebates, making sure that your wholesaler is paying you and your buying group is paying you the rebates that are due is really important. And so breaking them out and having them as a contra cost of goods is really important.
Yeah. Well, Bobby, what's your stance on the DIR rebates? I mean, do you like to see them in a certain place? Do you care? What is your thoughts on this?
I would say, probably don't necessarily care. I do want it recognized somewhere. I mean, I'd like to see it somewhere just so you can see what that trend is. Like you said, Rich, you're seeing it go from 3 to 8 to 9. So whether we're evaluating existing pharmacy or somebody looking to buy one, you're going to want to know what those look like and where they're trending, for sure. So just as long as they're broken down in there somewhere.
Yeah, I mean, we have seen scenarios where, we see revenue and it just says revenue and DIRs weren't even accounted for.
Yeah, they're
They've
there.
overstated. Yeah, we've seen people pay taxes on DIR fees that they didn't report. And same with rebates. We've seen really low margins that make the store not look good, and the rebates just weren't in there. Those things happen, though not very often, but when we're evaluating the store, it gets really difficult if we don't know what those things are. Having a line item, and similarly, with like payroll and stuff, it's really good to, a lot of times what we see is just payroll. Well, now we don't know, like you as an operator don't know, is that how much of it went to pharmacists? How much of it went to techs? How much of it went to drivers? Admin, is one of those costs increasing? You can take that too far, but having some kind of breakout that you can quickly look across, 12 months and go, did something increase here or did it decrease? So like what's causing my either good or bad performance? And I think some of these key items like that are important to break out and have your eyes on.
Yeah, I think it's really important to identify, the key pieces. Clearly the margin, right, where you're breaking out your revenue and have some detail about your revenue. If you've got a lot of OTCs, if you've got a lot of other types of sales, breaking those out from your RX sales and breaking those margins, because tracking those RX margins really important. And then, so the revenue and cost is clear, but like you say, getting some level of specificity with the personnel costs, where you're looking at, by job class, whether it's pharmacist, technician, do you have salespeople, do you have drivers, do you have admin people, benefits that you're paying for on top of just payroll taxes. So breaking out those line items, and again, focusing on key larger material items, not minutia, right? So having a line for utilities is great, but breaking out your water bill and your in a line item and your phone and your electric and your gas bill. So being able to categorize things and again have enough detail without getting carried away and having so much detail that it becomes difficult to quickly get to the bottom line and figure out what's happening, because we'll see it's also a timing difference, right? So it's important to get those financials in your hands quickly so that you can make decisions. And if you're holding up your financials or your accountant's holding up your financials because he doesn't know how to classify a $50 Amazon charge, is it cost of goods, is it office supplies, at the end of the day, it doesn't matter for $50. You've probably got, $200,000 plus of revenue running through this business. And yes, it's good to have it properly classified, but at what cost? So that's when we talk about materiality, that's kind of the concept, is that, okay, there are certain things that just aren't going to matter. So let's put it in office supplies and move on and get these financial statements published in your hand and available to you to start making decisions. And that's, again, the simplicity of the financials, having enough information, but not too much that you're confused by it, doing cash, having them timely, and focusing on those things are kind of the key things that we think enable you to have the information at your fingertips to respond quickly to changes in the industry. And at this point, there's a lot of things going on, right? So you got to be quick to act and understand the directional,
Yeah, we see it on the buy side all the time where, where financials are getting hauled up by something, or, a $50 charge that they just don't know what it is. And from an operational standpoint, it's like, okay, my financials are delayed. And then I find out 2 months down the road that I was buying way too much inventory. And that was a $50,000 problem. And because I didn't have my financials, I fixed it 8 weeks later rather than I should have. And then from a financing standpoint, Bobby, how many deals get held up because you don't have financials?
Yeah, it's not uncommon. I hate to paint with a wide brush, but typically, the good operators can turn something around to you in a very timely fashion. And the ones that we struggle with are the ones that can't, whether that be by their own fault or their accountants or whoever. But that's typically the case. But yeah. It's more common than and we typically require something within 120 days. So it's not like, it gives you 4 months. If you can't produce something within 4 months, then you need to look at it.
Yeah. And then what if you need a working capital loan, or you need, a line of credit or something like that, and you don't have your financials together over something immaterial? Like, the bank doesn't care that you've categorized, some aspirin you brought from Amazon down in office supply. Like, that didn't make an impact to the lending decision. Now, if you just didn't include DIR fees, that might cause a problem, but that's a big item, right? That's a big dollar amount. So you can always go back and adjust those at the end of the year, as the accountant audits it. It's important to get that stuff in your hands and get the main things accurate, both from just an operational standpoint, but also if you plan to make any kind of financial move, whether that be selling or getting a working capital loan or what have you.
One other thing I was going to mention too is, as Rich was talking about in the simple financial statements, on cash basis, basically a P&L there is more like a cash flow statement almost. You can take that and adjust it for like maybe fixed asset additions and taking also into account any debt payments and any distributions, and you only have your cash flow together. On an accrual basis, financial statements, you have the balance sheet and P&L, and also you need a statement of cash flows, a separate statement that kind of takes you through what the cash flow was. Or on the cash basis, you don't need that because you've kind of already got it. So that's another benefit on the cash basis side.
Yeah, I think that's a good point. I mean, and that points to the simplicity of it. When you look at your net income on a cash basis financials P&L, you're pretty much looking at cash flow. And there's a couple exceptions to that. And those exceptions only occur because nobody's purely on cash, right? So it's a modified basis of cash. You're still, like Jim said, if you buy a Parada, you're still, capitalizing and putting that Parada as a fixed asset on your books. We account for debt. So any debt that you have, any borrowings from First Financial are going to be shown on the balance sheet. Inventory is required by the IRS to be on your balance sheet at year end. So there are a few things that now with the inventory, the other thing is, even if you're above, let's say you're above that 27 million, and our business was well above that 27 million, we could not do cash basis financial statements for our banks or for the IRS. But what we could do is we could run it cash basis throughout the year, and we could make conversions either quarterly or annually, right? We could put the inventory on, we could put the receivables on, and that's what we did. So even though every store has to have inventory on their books at the end of the year, we can freeze that inventory throughout the year, run the purchases through the P&L, and at the end of the year, clean it up and adjust the inventory to the actual amounts at year end. So it allows us to quickly close the books at month end. And then at year end, it's a little more of a hard close where it takes a little more time to make sure that the numbers are right. So there's an ability to kind of, again, it's a modified cash basis. It's not pure cash basis, but back to the point is when you're looking at a cash basis P&L, you take that bottom number, adjust the principal payments on your debt and any distributions, and you've pretty much got your cash flow. Whereas if you're accrual, you got to work through a fairly complicated cash flow statement. So and again, the most important thing to your business as a small business owner is the cash, right? So that's the thing you're trying to get to the bottom line is what did my cash do this month and where to go?
Hey, Rich, I've seen balance sheets that don't have any inventory on there at all. How would that happen, and should that ever happen? I mean, we think we know the answer to the second part.
It was, under the Trump administration, there were some modifications and some wording changes to some of the regulations around inventory, and it was a de minimis inventory. So, and there were interpretations, and we took this in some of our clients as well, where we felt like inventory down to the tablet level was de minimis and therefore could be written off in certain cases. And so a lot of stores did that, and they took advantage of that because now, if you've got $150,000 on the books in inventory at year end, and you can write that off because you paid for it, right? And again, that's getting back to cash basis. I paid for that inventory. I can't take a deduction for it. Well, under the Trump administration, that was somewhat allowed. Under the current administration, that was reversed. And so kind of pulled back. So it caused a lot of chaos, right? So now all of a sudden you had zero inventory. Now you have to put it back on. Some people haven't put it back on, or some people never had it on. Doesn't make it right, but you see a lot of that out there. And there was confusion around the interpretation of de minimis inventory and supplies, and then also the adding back and then the taking away and the changes in the tax laws.
So technically right now, you're supposed to have inventory on the books, correct? That is the IRS rule.
That's the stance.
Yep.
We've actually got a couple other questions that have come up. One is First Financial offering any kind of financing or line of credit for the DIR double dip that is coming? Is that something that you guys have thought through or are working on, or
We're thinking through it right now. Right
Yes.
now it's not an offering we have, but we certainly are aware of what's coming and trying to find a product that would be beneficial. At very minimum for our current customers. So
Yeah,
I
yeah,
think
that's what I'm hearing from almost every bank, Bo, is they're trying to figure out. That would be kind of a unique loan, right?
Yeah.
Yeah. So,
it's probably going to be something that, we probably need to do a whole nother webinar on that DIR cliff that's coming on January 1st. I can tell you, I mean, there's a lot of good information out there. I think HealthMart has a pretty good tool. There's definitely, if you get into your Elevate or your FDS or your reconciliation, this is again the importance of having that reconciliation service, right? So I can pull, for our clients, we were pulling reports and looking at DIR clawbacks. And again, really the main culprit is CVS Caremark, right? When you look at Humana, Aetna, a lot of those other big payers, most of those are currently at the register. So you're getting a DIR and it's coming out within a 2-week payment period, coming back out. So those are already at the register. It's the CVS Caremark ones that are tending to be the problem. And what we're seeing there is they're about 150 days out on those Caremark, some of those Caremark, and you're probably looking at SilverScript and AARP and those types of plans. And so there is some planning, but if you're running, let's say, $100,000 of DIRs annually, depending on your balance between that payer mix, half of them are already at the register and are not going to be a double dip, right? You're going to continue on at this. Now they'll even move closer. So when you adjudicate, you should be able to see the DIR, which will be great to know, not have to wait 2 weeks until you get paid. But it's those Caremark plans that, you're filling in August and September and they're coming out in January, or you're filling in October, November, and they're coming out in March, or December coming out in April, that are going to be the challenges. So those are the ones you need to look at as we get into the second half of the year to determine, what the extent of the problem is. Is it a $10,000 problem? Are you paying about 7%, of your brand purchases or your brand sales in DIR? And so what are you filling under those Caremark contracts? And look at that in the second half. And we'll probably have to have a whole nother, but we've been reviewing that. Again, it's not as, so if you're sitting there with $100,000 of DIRs on your P&L, you're not going to have $100,000 problem. You're going to have a subset of that that's going to be an overlap. And it's probably half of that or less, even unless you're just totally heavy on the Caremark Medicaid type business.
And that actually ties into really well with what we were talking about earlier about having timely financials, because whether it's First Financial Bank or the place you have your operating account, you're asking for a line of credit. Everybody's going to ask for this stuff, and then one how much you're going to need, right? And you don't want to ask for 20,000 and then you need 50. So know how much you need, and then be able to provide a timely, accurate financial statement for them.
yeah,
Again, it comes back to that reconciliation, and we see stores that do not do reconciliation or sign up for reconciliation or keep up with their reconciliation. And that's just a really big challenge. You can't get back to some of these numbers and can't really understand your store very well and these DIRs and stuff unless you've got some form of reconciliation. I doubt it. We used to do it manually way back, 15 years ago, but now you can look in the DIR in your reconciliation service, and some of the better ones give you really good reporting on it. And it's not fun to look at. Again, the numbers keep creeping up, but it's a reality, and you can really, make you need it to make some decisions, right?
Yeah, and that was a point that I was going to bring up is we know the cliff's coming. And still to this day, there's a lot of owners that you talk to and they can't tell you what their DIR fees were last quarter, let alone last year. And so having this conversation now with your accountant and finding that reconciliation piece so that you understand your numbers and know how to plan accordingly. We know the storm is coming, so you need to start planning now. Don't wait until December. There's no ifs, ands, or buts about it. It's on its way. And so formulating a plan now is your key to success of your pharmacy and the financial health of your pharmacy.
Yeah, it's interesting. These other questions are around DIR fees, but not about the cliff. So one was, what's the difference between reporting third-party income post-DIR fee, net third-party income, versus reporting the gross third-party income and a DIR fee as an expense?
Well,
Nothing
again,
really, right? I mean,
it's
end of the
just
day.
giving you visibility to, is that DIR, you get to the same bottom line.
Yeah.
But
Now,
again, what is your problem? Is the problem that your DIRs are creeping up, or do you have particular plans that are not necessarily good, and so your actual reimbursement upfront isn't good? I mean, it's a valid point that, at the end of the day, your revenue is your revenue, but and if it's going down, it's going down, whether it's because of DIRs or reimbursement. But having more visibility to understanding why, and then, going back to your state senators and your there's so much action on this, and that's part of the push to get it at the register is transparency and visibility, right? And so the more we can understand those things and talk to our state senators and our national representatives and so forth to get these things changed and understanding of what they are doing to our business. The reimbursement's nice, but when it's got a 10% and it takes you from a 3% brand 3 or 4% brand margin to a negative 2% brand margin. That every brand you fill after DIR is losing money.
and there can be a tax implication of doing it, right? So if you deduct DIR from income, I mean, in some states they tax your revenue, right? And so you have sales tax on.
Here in
Taxes,
a few
states,
like here in Ohio, we're out of Ohio, so Ohio has a CAT tax, which is based on revenue, gross revenue. And so if you're showing your DIRs down in expenses, you're not showing your net revenue. So we'd rather see net revenue, a lower net revenue as you pay your tax, right? So there are some minor tax implications of how you report it as well.
It also kind of shows you a false gross profit because you didn't really get paid that. So it kind of goes back to that cash thing of, I mean, if you have $300,000 worth of DIR fees and you don't deduct that from revenue, it makes your margin look like, a little bit better than what it really probably was.
And when you pull that reconciliation, those reports, I mean, you're getting other fees in there that aren't truly DIR clawbacks. You're getting statement fees and other things. But again, we lump those into a category that is basically clawback from or ways to find any fee that they possibly can from the PBMs. So we use that to offset revenue.
On those lines, someone asked, are DIR fees deductible? Well, technically, yes, because they're considered an expense of some kind.
Yes.
Yeah, as long as you're accounting for them correctly and getting them into your P&L. If you're missing your P&L somehow, but as long as they're getting into the P&L, reducing the revenue, it is a deduction. It's reducing your tax liability.
Yeah, and then someone put in here that there are PSEOs that are escrowing DIR fees, which will help mitigate impact on pharmacies using a particular PSEO. I mean, that's true, but they're hitting your cash now.
Yeah,
so
that's like overpaying on your payroll taxes all year long so you can get a refund. They're not paying you interest on it. Now
taxes.
It is planning for it, so that's good. So
I'd rather you plan for it, put the money aside in a money market account that now is earning 4.5% and being prepared for it down the road instead of letting McKesson or somebody else hold on to your cash for you. So, but the important part is that, and what they're trying to accomplish there, right, is to make sure that you don't get to March of next year and run out of cash, right? That there is a reserve, and that, so understanding what the problem is and how much it is, and then preparing for it either through savings now or potentially solutions with your bank to make sure that you're covered.
But that is a good point that they bring up here, is that PSAOs are, some of them are holding these dollars back. So, you may want to check, because you might be getting paid less than you think you are right now. And that can affect your cash. So if you're not aware of that, and that's another reason to do cash accounting and make sure your reconciliation's up to speed, because, you would see that decline in reimbursement. You wouldn't be receiving this cash. So, you like, because they're holding those DIR feedback now. And so we've got to, you got to pay attention to that. And if you're not aware of it, it could be a problem in the short term versus the long term.
Right.
So, okay. Anyone else got anything to add? Bo, Bobby?
I mean, I think the
good.
whole gist was, make sure you get your timely financial statements, make sure you understand what you're looking at. Are you looking at accrual? Are you looking at cash? Understand the limitations and the positives and the negative of both, because you are going to read those financial statements differently. Don't worry about the small stuff, worry about the big items that can really impact your business. And that is your revenue and the volume of revenue, the cost of goods, and how you're purchasing, and the payroll are the big bucket items that you really need to be focused on. And again, make sure you've got those financial statements in your hand and you understand what you're looking at and you're making decisions.
Great. Yep. Okay. Well, we've had a couple questions about sharing this recording. We will be recording. We are recording it, and we will post it on LinkedIn, and we will also be doing an email blast. You can find it on our YouTube channel. We'll also pass it on to First Financial, who may send it out as well. If you need to reach us, we're at independentrxconsulting.com. First Financial Bank, it's the best way to reach you guys.
ffb1.com and @pharmacylender.
So you can reach us there, and then simply if you Google any of us, you'll find us as well. So thanks everyone for joining, and yeah, Bobby, Bo, really appreciate you taking time to do this.
Thank you, guys.
Yeah, thanks.
Thanks everyone.